the debt's higher, the deficit's higher. It keeps all going back to the same thing, which is it won't work mathematically. Away from the politics, it mathematically is impossible to work unless you devalue the dollar, devalue the debt first. And I think there's a really good chance we see some sort of Sunday night surprise in the first half of 25. We will see gold skyrocket. We will see Bitcoin skyrocket. We will see stocks skyrocket.
Luke Gromen, founder of FFTT. It is so great to welcome you back to the show and great to see you again, Luke. Thank you so much for taking the time to join me.
Absolutely. Thanks for having me back on, Julia. It's great to be here.
Well, I'm thrilled to have you back on, and I want to get you on more often because I got to say, Luke, our audience loved having you on last time. And so we're thrilled, especially as we head into 2025, and so much has happened in the last 12 months, it seems. So let's start, more with that, big picture, where we are today when it comes to that macro picture. And, one of the things about you, Luke, is I feel like you're one of these guys who's really good at connecting the dots. So I am curious, what is the big picture macro view for you today? And you can take all the time you need to set the table.
I think there's two kind of key overriding themes as we finish this year, move into the next. And the first thing is, to me, I have very high conviction that U.S. policymakers will weaken the dollar in 2025. I do not have any conviction in what they will do over the next 3 to 4 months. And so I'm thinking about right now as a period of sort of in between two trapezes, to kind of to use a Coldplay lyric, where we're leaving one trapeze, we're in midair, we're about to grab another. When you look at Scott Bessent's 3 arrows, for example, none of them work unless the dollar's lower. Pretty much full stop. Not quite full stop. There's some regulatory wiggle room, etc. But basically, the 3 arrows is like dollar down. Now, between here and there and some of the different potential policy changes, tariffs, DOGE, etc., you could actually drive the dollar up. They could drive a risk-off air pocket. I have very little conviction in what could happen over the next 2 to 3 months, 3 to 4 months, I guess. That's sort of point one. So there's sort of two discrete periods, next 3 to 4 months and then beyond. The second thing that I think, and it's more overriding, it's a little more qualitative than quantitative. But I've just been watching a lot of signs and hearing a lot of, we'll call, credible rumblings that the market regime really began changing at least a little over 2 years ago, almost 3 years ago, with the Russian sanctions on FX reserves, in a way that I would summarize as DOD and certain intelligence establishment parties are now driving the marginal economic decision, not an end policy, not Treasury and the Fed, as has been the case for the past 40 years. And I would summarize it thus, which is, when the Japanese bombed Pearl Harbor in 1941, FDR didn't get on TV the next day and say, we're going to war in Japan and Germany if the bond market will last. He didn't say that at all, of course. He got on and said, we're going to war. Friggin' figure it out, bond market. Figure it out, Fed. And I think this reshoring, reindustrialization, MAGA, MAHA, all this stuff, however, setting aside how people feel about it politically, objectively, there's a major change in trade flows that we're talking about. And most of Wall Street, to me, seems to still be thinking, well, when are the bond vigilantes going to show up? I don't think they're going to care. I think DOD, intelligence, and certain other interests have said, here's what's going to happen, figure it out. And so that is some very important market allocation things we can dive into. But those are kind of, as I sit here today and look out, my two big things, which is I have no idea, next 3-4 months, we're in between true trapezes, but then I think ultimately we're going to get a weaker dollar in 2025. And then we're no longer in Fed Treasury rules markets. We're in DOD rules. And those are very different rules.
Wow. Okay, this is fascinating. And I got to say that this is the first time I've heard this, but you got my attention. I would love to explore this more, this kind of like new paradigm then with the bond market, if it's not the Treasury and the Fed, but rather the DOD. Can you just flesh it out a bit more for us and help us understand like the implications? And I think that's interesting too. Like, it's not like we're not going to have the bond vigilantes show up. It's just help us understand a bit more of this thesis.
Sure. So I think the easiest way to highlight it is to start with something that's frequently said, right? Which is US dollar is ultimately backed by the US military, or there will be nobody to replace the dollar system until someone can, no other military can take that from us. Hear that fairly often in some way, shape, or form. Or, gee, Luke, who's got the military that can defeat the US? And the answer was highlighted by Neil Ferguson about 8 months ago, which is that for the first time in US history, US interest expense on our debt net is higher than the Defense Department spending. And what he pointed out at the time is every hegemon going back 300 to 400 years that has had its interest go above its defense budget ceases to be a hegemon fairly shortly. And when you start from that point of, is the US DOD and the US establishment going to stand aside and say, oh, gee, we have to respect market pricing of the bond market, and in so doing, cut back on defense investment and cut back on entitlement investment so that we can pay our bondholders? In my opinion, the odds of that happening are basically zero. What's fascinating is the odds that Wall Street appears to still be placing on that happening is like, that's everybody's base case. Oh, well, we're going to respect the bond market. The bond market is banned. They'll never kill the bond market on a real basis to support the Defense Department and entitlements. That'll never happen. I think it's a sure thing. So that's I think, kind of started that thought process. If you want to go back even further or kind of overlay something with that, you can go back to October 2018. There's a unclassified version of the report assessing the defense manufacturing industrial base or something like that. And essentially, it's 128 pages of how increasing portions of the U.S. defense industrial base is either single or dual source to China, which is a problem because we're borrowing money from China to build weapons to face down China, according to this report, using increasingly Chinese-made components. And only an idiot would think that's a good idea. And the defense and intelligence guys aren't idiots. And so they've been looking at this for 6-7 years at least. I hear that the situation is worse as it relates to the hollowing out of the defense industrial base since then. And then I think the last thing that has really, because this is something we've been talking about for 6 years, the interest expense thing happened 8 months ago. I think the other thing that has really accelerated this dynamic and made it, not a someday thing, but a now thing is NATO lost in Ukraine. And they lost because they couldn't keep up with production. And so when you start seeing objectively 155 millimeter shells, Stinger missiles, tanks, etc., an inability for the U.S. and NATO defense base to keep up with a Russian defense industrial base in an economy that is allegedly 1/10 the size of ours and under sanctions, you realize that, and we realized that we've got a huge problem that needs to be fixed yesterday in terms of getting our defense industrial base back to speed. And here again, this isn't, people say, well, this isn't a problem per se. It's only a problem if you want to maintain market pricing of a long-term bond market. Just like in 1941, when we said, we're going to go to war with Japan and Germany at the same time, it's going to be really inflationary. FDR didn't say, well, I'm going to ask the bond market and Wall Street first. He said, get it done. And what happened? What happened was the Fed capped yields at 0.3% at the front end, and they capped the 10-year at 2.5%. Most of the issuance was done at the front end, and the Fed's balance sheet off a low base grew 10x in 9 years. And I think we're in the very, like maybe the warm-up innings of something similar happening again. We're going to shift issuance to the front end. If they have to, the Fed will buy it. I think stable coins have a role. We can talk about that later in terms of being who can be financially repressed. And the Fed's balance sheet's probably going to grow a lot. And I think you're going to see inflation pick back up. And that is what it is.
Yeah. It sounds like all roads lead to inflation then.
Yeah. It's in short, yes. And it's just supply chain disruption on a more structural basis. People, a lot of the economists say, well, look, inflation picked up with COVID and have since rolled over. Now it's stopped going down in recent months. And I think that's an important signal. But most economists will tell you it was mostly supply chain driven. Yes, there was liquidity injection, blah, 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 but it was mostly supply chain driven. Okay, let's go with that. Let's pull on that thread. If the United States does not want China making most/all of its defense equipment in 5 to 10 years, it needs to completely reorder supply chains in a way that makes the disruption of COVID look quaint by comparison. So, away from sort of this acute sort of COVID disruption, this is wholesale, major. It's going to start glacial, but I think it's going to accelerate pretty meaningfully. So yes, I think it's a very secularly inflationary environment over the next several years. Again, out of realpolitik that goes back to, we're not going to stop investing in defense because our interest is above defense. It's simply not going to happen. The release valve is going to be the currency and the real value of bonds, and probably some form of soft capital controls / soft form of yield curve control light, etc. And the release valve are going to be, it's good for the stock market. It's great for gold. It's great for Bitcoin. It's great for America. It's great for domestic wages. Long-term bondholders are going to pay the price on a real basis. They might actually make money a little bit on a nominal basis, but on a real basis, they have to lose or else the U.S. loses or else DOD loses. And, one side's, got a sort of, a bunch of nerds with calculators, and one guy's got a bunch of guys with haircuts like mine and guns. So, choose your fighter.
Okay. I want to hear more on the release valve being the currency. And yeah, I want to explore that a bit further.
Yeah, ultimately, that goes right back to, hey, we need to stop making XYZ component in China, Vietnam, Mexico, whatever. We're going to bring it back here. Okay, well, we need to spend $100 million. Okay, well, we don't have the labor. Who cares? Print it. Well, the labor's going to go up. We don't care. We have a printing press. Print it. Well, we're short the steel. Don't care. Print it. Like, they'll just print the money. And that ultimately, again, rates won't be allowed to go up beyond a certain point. We know that. We've seen that empirically demonstrated 4 or 5 different times since 2019, starting with the repo rate spike, right? When repo went to 8 to 10%, the Fed didn't say, oh, look, the market's setting the rate at 8 to 10%. No, the Fed said, oh, God, the market's setting it at 8 to 10%. Market, you're wrong. 48 hours later, they did not QE, which was just, holy cow, inject liquidity, get those rates back down. They did it again in COVID. They did it again in the third quarter of 22. They did it again in response to the banking crisis. They did it again in response to 3Q23's issues. So when you say it really comes down to the currency of the bond market, right? If you say, I'm going to build this, the bond market can say, no, you're not. Or the bond market can say, no, you're not. And the Fed or whoever is going to come in and say, yes, they are. And they're going to push down yields. And they're going to push down yields by creating more currency units. And that's why I say the release valve will be the currency.
You mentioned too, like one of the implications would be it would be great for like equities, the stock market, Bitcoin, wages in America. Can you expand upon that dynamic?
Yeah, ultimately, they're going to pay to get it done, and they're not going to let the bond market yields rise to try to stop it. And so ultimately, that cash is going to flow into equities, into Bitcoin, into gold. And particularly, and I'm not opining on what is the right immigration policy or not, but presumably if we stifle immigration, instead of the release valve being 10 million more people in this country, if there's not 10 million more people in this country to do the work and the work actually goes up, then the release valve will simply be the price of that domestic labor. And so what you would actually see is a narrowing of wealth inequality in this country between asset holders and the middle and working class for the first time in 40 years.
So that would actually be a good thing, though.
It'd be a great thing. Oh, it's great for everybody. So it's great for everybody except for, people that own too much in long-term bonds on a real basis. And their choice isn't have this happen or not. Their choice is have this happen on a real basis or have this happen on a nominal basis. In other words, we're going to haircut you nominally.
Okay. So the long-term bondholders are the losers in this scenario. Maybe
only on a real basis.
Okay.
The Fed could cap rates at 2 at the 10-year, in which case they'll quote unquote make money nominally, but the S&P will probably double. Bitcoin will probably be 5x. Gold will probably be 2, 3, 4x, whatever.
Mm-hmm. I was going to ask, maybe it's a silly question to ask too, but is there a geopolitical dynamic to this as well for the long-term bondholders?
From a standpoint of
just, I guess on a real basis, if they're the losers, just curious, thinking about who owns the long-term bonds, who are those holders?
It's interesting, right? Because throughout my entire career, U.S. retail bluntly is almost always the sucker at the card table,
mm-hmm.
right? They're almost always who gets plugged with this stuff, whether it's the .com bubble or it's, subprime housing or it's, they're always kind of, when retail is buying something hand over fist, that's usually, they're usually the last guy there.
Yeah.
And so when I describe this process of haircutting domestic, long-term bondholders, central banks stopped buying U.S. Treasury bonds on a net basis 10 years ago. China stopped buying over 10 years ago. Russia stopped buying 10 years ago. So the Japanese have barely bought. So when you look at sort of who's been buying, it has been banks, U.S. banks who've been forced into it, U.S. money market funds, U.S. pensions. They're also, unfortunately, usually sort of late in the party. They've been regulated into buying pensions. But over the last 2, 3, 4 years, if you look at the Treasury Borrowing Advisory Committee report, 60% to 70% of issuance at the 7 to 30-year tenors of the Treasury bond market have been what they define as investment funds. So it's retail. And so ultimately, what have foreigners been doing? These foreigners have been realizing the inevitability of this for 10 years. China's not bought treasuries. They've been buying gold. They've been buying real estate. They've been buying copper mines, coal mines, oil fields, etc. Ditto the Russians. Ditto, and sort of anybody that did that, by the way, was quickly denoted an adversary. But ultimately, foreigners will not lose. It will be the domestic investors that lose on a real basis. Again, they'll get paid every dime they're owed, just like they did in World War II, right? People who bought war bonds during World War II, they got paid every dime they were owed. It was just that the S&P 500 rose 5x from 1941 to 1951, or 1942 to 51, relative to their bonds. And gold was not allowed to be owned by the U.S. populace then, and we had rationing of consumer goods. So that entailed inflation for the first half of that period. And second half of it, they took the rationing off and inflation exploded. So real rates, I think in the U.S. bottomed at negative 13%. So inflation was 13 points over the yield on the Treasury bond. And that's the kind of thing we'd be talking about. So ultimately, pensioners that have too much money, retirees who have too much money in long-term bonds are the ones most at risk of this. I encourage them to own some gold, maybe just a smidgen of Bitcoin, and have some equities, and they'll be fine on a net basis. It's really the long-term bond market, and particularly domestic holders of it, that will suffer because, again, DOD is not going to not invest because the bond market says it can't.
Okay, so equities. I heard you say maybe 5x on Bitcoin and gold could 2 to 3x. Is that correct?
Those were just numbers I was throwing out, but for that example, right?
Yeah.
If some of that depends on the scale of reshoring, it's ultimately around the scale of this whole process. But I do think there's massive upside to both of those because, again, it's the bond market, unlike 1942 to 51, is enormous. And I don't know what it was. I should know for this purpose. I'll have to look offline later. But global bond market's $130 trillion. And so it is a very, very big animal that you're going to try to hold down and not let it move. Basically, you're going to try to anesthetize it. It's going to want to sort of move around a lot. And what does that mean? Means to keep yields below levels that the U.S. government can afford is going to require a lot of dollar printing, a lot of liquidity. And, importantly, it doesn't have to last forever because the lower the dollar goes, the higher we get nominal GDP as a result of what we're talking about here, which is severe financial repression for a compressed period of time. The deficits you need to finance will shrink. You'll be able to get the deficit down by growing rapidly and achieving these strategic geopolitical goals at the same time over the backs of the purchasing power of long-term bondholders.
Okay. So let me ask you this. I'm looking right now at the U.S. debt clock. I like to check it every now and then. 36.23 trillion for the U.S. national debt, ticking higher. The last time I had you on, Luke, I think we were at 33 trillion. And gosh, it hasn't even been a full year, to be honest. That's wild to me. And it's a very basic question, but are we past the point of no return here? Or can we actually do something to course correct?
No, there's always something you can do to course correct, right? It's, I said recently, I have come to really abhor the phrase the end game, right? Because the game never ends. It's just the rules change. And it's that. When those rules change that you make or lose the most money. And what I'm talking about here is just a rule change. We've had 40 years. And I would argue, again, the rule change probably started 2, 3, 4 years ago. You even go back to COVID maybe, right? But the bond market was in a 40-year bull market. You never went wrong buying long-term U.S. bonds. Yeah, you had some counter-cyclical moves. And that rule has changed. So is it too late for us to course correct without a major rule change of the sort that I'm describing, without really impairing the real value of long-term bonds? Yes, it absolutely 150% is way too late. It's over. What does it's over mean? What does, in terms of that era, means we need to have a rule change. And the rule change is a rule change that has happened countless times in history, which is, you go back 5,000 years, you can read about in the history books, in the Bible, in the Old Testament, debt jubilees. This is basically just a debt jubilee, except debt holders are still going to get every dollar they're owed. The jubilee will just take place in the value of the currency that they're paid back in relative to harder assets. And harder assets are gold, Bitcoin, and equities. And I think certain types of equities more than others, but it's basically just a rebalancing that needs to occur and will occur because the debt is too high.
Yeah. We have a lot of, I guess our biggest items are they're really fixed things within the debt, like Social Security. You mentioned defense spending as well. Our biggest items, and Medicaid, Medicare. What are there things that we can do around the maybe more of the entitlement spending? It's a topic that comes up on the show. Is there anything that can be done there?
Sure. There's a number of things you could do, right? So let's start with the happy one. The happy one is we can, really increase efficiency with how we administer healthcare, and we can encourage everybody to get thin and healthy in a way so that they use less healthcare. And we can fix the food supply, so you can see some of these types of things. Now, there's kind of a lag on those impacts, and importantly, and this is something Obama, I read a fascinating interview of Obama 18 years ago, 18 years ago, before he was elected president, a reporter, I think for the WAPO at the time, I think it was David Sirota, was talking to him and say, you seem to be backing off your Medicare for all. Why? And he said, look, there's 1, 2, 3 million people employed by healthcare administration. What are we going to do with those people?
Yeah.
You had, and so that's part of the challenge of this whole DOGE thing, where I've said there's got to be an order of operations, and why I said it was too late with 36 trillion. Had we done DOGE in 2001, when the U.S. was running a surplus and was debt was literally over $30 trillion lower than it is today, yeah, you'll have maybe a modest recession, but who cares? You can restructure the economy. Now, if you try DOGE or you cut too many healthcare administrators, with 36 trillion in debt and 7% plus deficit of GDP, you're going to go into a death spiral, basically. Because what's going to happen is you're going to actually, the U.S. government, by the way, is also 25% GDP. So you're going to shrink part of GDP. You're going to go into a recession. When you go into a recession, the dollar tends to rise. Foreigners are short $13 trillion worth of dollar debt because thanks to Bernanke and the Fed in 2008, the dollar was turned into a funding currency. So now they're short 13 trillion in debt. The dollar starts going up on them. They have to start selling something to raise dollars. What do they have? Well, they've got $57 trillion in dollar-denominated assets, including $8.5 trillion in Treasury bonds. They're going to start dumping Treasury bonds to get dollars. So now your rates are going to start going up in a recession instead of down like they always do as your receipts drop, and our receipts are very highly interest rate sensitive. So our receipts are going to start dropping at a nonlinear rate, which is going to send our deficits up at a nonlinear rate despite the cuts. And that means you're going to have to issue more as foreigners are selling. So your net issuance is going to explode into a recession. You're going to end up with way higher deficits to GDP, higher interest rates in a recession. And the U.S. government's quickly going to get to a spot because of the 36 trillion where, oh my gosh, the interest is more than the interest alone. Forget about defense, forget about entitlement, forget about all of it. The interest alone is more than the receipts because receipts are so interest rate sensitive because we've financialized for the last 40 years. So once you get interest just even too close, let alone over 100% of receipts, you're done. You either default on your national debt or you print the money. Now, conveniently, both of those basically end in hyperinflation for a period of time because the debt backs the currency and sort of all other assets out there. So if the U.S. government were to ever come out and be like, oops, our interest is above our debt, we have to haircut our debt by 80%. Well, like everyone on Wall Street's head's going to explode because like that's all their risk-free collateral backing everything, including quadrillions in derivatives. Well, okay, now everybody has a margin. Oh God, you know what's going to happen is gold's going to get written up like 2 extra zeros at the end of it. To replace all that collateral. That's what would happen, and that's what I mean by hyperinflation. So that is the problem with let's just get more efficient, because ultimately the inefficiency in a debt-based system, like Obama said, you know, when healthcare was smaller than it is today, when our debt was lower, what are these 1 to 2, 3 million people going to do? And by the way, these 1 to 2, 3 million people, they have mortgages, they have student loans, they have car loans. So if we get efficient, you know, what are those people going to do? They're not going to all go learn to weld. You know, they're not going to all go learn to code, right? We saw what happened in 2001, that derogatory, well, we're going to send all the jobs in factories to China in manufacturing. That was 100% increased productivity. Sent 10% of manufacturing employment to China in under 2 years. And how did we get around this drag, the deflationary drag of that? Because those people had mortgages and cars and houses. Simple. We gave them all subprime loans, right? Oh, you went from making $40 an hour, full bennies at GM, and now you're a $12 an hour greeter at Walmart, no bennies? Here, take a subprime. Go buy a bass boat. Go buy a house. And that was fine till it blew up in 2008. And then it ended up on the Fed's balance sheet via printing. So like efficiency with the debt where it is and the deficit where it is won't work. It will blow up the system basically immediately.
Okay.
Then you go to other things. I have to be very delicate with this. Look, we know a disproportionate percentage of entitlement spending's done in the last 6 months of life. And, if there were some sort of pandemic that came out where, there was a virus that, disproportionately hurt older, sicker people, that fixes it. And it's horrifying to even think of. But that's the type of dramatic, like it's the kind of thing, like, you don't want that. And then the last thing is, just, I guess, some sort of miracle productivity energy thing. And that's maybe the most optimistic thing. But I think it's like, sort of nuclear fusion, like, rolled out in the next 2-3 years. We'll see. But I don't see that on the horizon.
This might be very simplistic as well, but like 65, and I don't want to offend anybody by any means, it's not that old. And I know when Social Security came online, like, people didn't live as long. Is there a way to just like gradually increase? I'm talking about like a couple months, like almost waterfall it. I don't know. I kind of assume like I'm going to get like a huge haircut on Social Security or not get much. I don't even know if it'll be around when I need it, but it's a very contentious issue as well. But is there anything that could be done with Social Security that would actually make sense? Not like, annoy a lot of people with the changes, or is that just never going to happen?
Well, let's set aside the political side of it, right? Because I think politically it's called a third rail for a reason. I don't think it'll ever happen.
I don't think anyone will get elected on it. Yeah.
No one will get elected on it. But let's pretend that they could. Let's set that aside and let's just stay with the math, because we can debate the politics. We can't debate the math. The math is the math. You can go back to 2015. Peterson Institute held a panel with Alan Greenspan, Richard Fisher, who was the former president of the Dallas Fed at that time. Mm-hmm. Who was the other gentleman? Larry. Oh gosh, he's a former Fed governor too. And there was maybe one other former Fed governor. And the point is this. They laid out in 2015 that if you cut entitlements, you're going to change the consumption patterns of the economy. In other words, if you tell people the money you thought was going to be there isn't going to be there, you're going to introduce first, everybody's going to go, okay, well, if they did one cut, that means they can do 2 or 3 or 4, right? And you change psychology permanently around those benefits. And what these 3 gentlemen, Larry Lindsay, right? So he's a White House guy and former Fed governor is the third guy. You permanently change psychology around these benefits such that everybody goes, oh, well, that's fine. I'll just save a little more, which promptly reduces consumer spending today, which promptly drives GDP down, which promptly drives receipts down, which promptly drives deficits up. And so now your attempts to reduce the deficit have actually driven deficit to GDP up. And conveniently, this is not speculative. They just kind of laid it out in economist speak. Something I've been highlighting for our client, for FFTT clients for some time is we have an actual empirical example of this. We can go back to 2014 with Obamacare, which was a tax increase. It was ruled a tax increase by the Supreme Court as being legal for that reason. The Wall Street Journal at the end of 2014 said the goal here is to have consumers have more skin in the game, to push healthcare costs from the government onto consumers to reduce the deficit. And 12 months later, because consumer premiums had gone up, they all of a sudden had to pay more for their own care. If you're getting something for free out of the cloud, right? The government doesn't have this money. They're just printing this money. They have, there's not some piggy bank that the government is spending this money. They're just creating it. So when the government goes from creating the money for you to saying, now you have to earn the money to pay for it, you have to change behavior. So in 2014-15, consumers faced a choice. I can pay my healthcare premiums, which went up 20-30%, and I have to pay more, or I can upgrade my car, take my family out to dinner, go to Disney World, blah, blah, blah. Growth slowed, consumer spending slowed, GDP slowed, tax receipts fell. And as a result, the deficit as a percent of GDP was higher 1 year, 14, 18 months after the Obamacare cuts were put in place to reduce the deficit. And now the debt's higher, the deficit's higher, everything's sort of gotten bigger and worse. Leverage cuts both ways. So like it keeps all going back to the same thing, which is it won't work mathematically. Away from the politics, it mathematically is impossible to work unless you devalue the dollar, devalue the debt first. Full stop. Because these guys didn't have the political courage to do it they probably could have done it a 102, but instead they said, let's go take the Taliban, let's go take Afghanistan from the Taliban and give it back to them and spend $8 trillion doing that for 20 years. Like mathematically, it won't work. You can't do it. It just won't work.
Fascinating. Do you think that there is a scenario where we would one day just devalue the dollar?
Oh, yeah. It's happened twice in the last 80 years. We're just about due. We did it in 1933. FDR came out and was like, surprise, dollar used to buy you $20 now, so now it's $35. Have a good day. And oh, by the way, we're confiscating all your gold.
That's, the gold confiscation. Okay.
That was a dollar devaluation. The next dollar devaluation happened in 71. Nixon said, surprise.
Gold again.
And I think there's a really good chance we see some sort of Sunday night surprise in the first half of 25. And I don't know exactly what it looks like. I'll know when I see it. But I think the symptoms of that are a lot of what we've seen, which will be over some brief period of time, we will see gold skyrocket. We will see Bitcoin skyrocket. We will see stocks skyrocket. You'll probably see some sort of soft regulations to sort of make somebody new try to buy treasuries and finance deficits. But ultimately, the devaluation will drive growth and inflation enough that your deficit shrinks. That's the only way to shrink the deficit is devalue the dollar and debt. And so we're at critical stages of that right now. And the reason that's why I say first half 25. Last 4 months, the metric we've been watching really since 2016 has been true interest expense relative to U.S. receipts. True interest expense is just the current portion of entitlements plus gross interest, and then compare it to total receipts. And every time they get, basically over 90% of receipts in just those two line items, they weaken the dollar. And now what's incredible is I tweeted this the other day, with Fartcoin being worth more than 40% of publicly traded companies, the U.S. is not even generating enough receipts to cover their interest and their entitlements. They have to weaken the dollar. And making matters worse, they've got a $7 trillion refinancing next year. Forget about what the incremental deficit is. They have a $7 trillion refinancing, and they're not even covering the interest and the entitlements right now, as we're going into a new Cold War, to tie back to the first point. So I think there's a very high chance we get some sort of surprise. Gold's $5,000. Bitcoin is some big number. The S&P is up 60% in a compressed period of time. Maybe the Fed goes back to some sort of, I doubt they'll call it QE. They'll probably call it something related to Treasury market functioning or, not QE or BTFP, right? They'll never call it what it is, right? Affordable Care Act wasn't to make it more affordable. It was to make it more affordable for the government. It didn't work. But, Operation Iraqi Freedom was not about Iraqis or freedom. It was just, so it'll be a Fed the Treasury market functioning facility or something like that.
Yeah, you can co-opt the language. Inflation Reduction Act. There you go.
Perfect example.
Yeah. I did not know that about, I'm looking at your tweet now. I didn't even know there was something called a fart coin.
Oh yeah, no, I didn't either until someone I saw it Hedge, I think it was. I'm I thought people were just making this up, and I'm no, this can't be right. I'm holy crap, this is right.
Wild,
right? So there's so much liquidity that's happening, and yet the government cannot cover out of receipts those two obligations. Now, some people say, well, they just need to raise taxes. Well, Tom McClellan had a great post couple days ago, where he highlighted You go back to 1933. Every single time that U.S. tax receipts go over 18% of GDP, U.S. has a recession. Full stop. Every time. Even in 2022, we had 2 down quarters of GDP when it went over 18% in a row. So it wasn't technically a recession, but GDP falls when you go over 18%. And we're basically there right now. So some people will listen to what I just said. Well, Luke, duh, they just have to raise taxes. No, duh, they can't. Because you're already at 18%. You go over 18, GDP falls. GDP falls, guess what happens to deficit? It explodes. The last 3 times we've had the deficit, or we've had GDP fall, deficit has risen 600 basis points, 800 basis points, and 1,200 basis points of GDP. So your deficit, if you try to raise taxes here, your deficit will go from 7 to somewhere between 13 and 20% of GDP. Kaboom. It's over. Rates would go up in a recession unless the Fed printed it.
Yeah.
This is where we are mathematically.
Yeah. Okay. So, Luke, your thoughts on the Department of Government Efficiency, Elon Musk and Vivek Ramaswamy, because you were just mentioning earlier, like, it's a good point. Government spending is a huge portion of GDP. Government jobs are a big portion of employment. What are your thoughts on DOGE? Can they be successful?
It depends on the order of operations. If they devalue the dollar and the debt significantly first, yes. If they don't, then they will fail spectacularly. And Trump will be a lame duck before the midterms. The Republicans will get swept out of Congress because the economy and the crisis will be so bad that they will completely discredit all Trump economic policies basically immediately. And then they'll do nothing for 2 more years and we'll wash, rinse, repeat and have all the fun we had in the last year with this political divisiveness in the last 12 months. And the reason I say that is it goes back that order of operations so critical is, again, 36 trillion in debt, U.S. government's 25% of GDP. All of these people have mortgages, car loans, right? You lay off government workers, you lay off healthcare administrators into an economy that leveraged. We know what happens. They stop paying their mortgages, and then the banks stop making loans because they're starting to take losses on their mortgages. And when they stop making loans, we go into a GDP decline. When GDP declines, go back to what we just said. The economy is going to have a recession, and a GDP decline is a recession. And in the last 3 recessions, deficit to GDP went up 600, 800, and 1,200 basis points of GDP. So you're going to send the deficit up by trying to do that unless you come out and go, now, something I tweeted about yesterday, some people thought I was joking. I quote tweeted Elon, and I think I'm not joking. If DOGE, I could cut $1 trillion next year right away. And I could have us in a surplus 2 years from now. It's simple. I cut rates to 0. I refi all the debt at the front end at 0. I bully the Fed into doing QE at spots when they need to. The dollar falls sharply. The economy explodes. The stock market explodes. Tax receipt explodes. And then next year, interest expense goes from, right now, pro forma interest expense next year will be $1.5 trillion gross. You take it to 0, boom, $1.5 trillion relative to what it was going to be in cuts in the deficit. Deficit shrinks by that. And then the tax receipts layer in as inflation, GDP, nominal GDP, stocks, tax receipts, wages, they all explode higher. And in this time, maybe by 2025, but certainly by this time, 2026, mid-2026, you're going to be running a tiny deficit, maybe a surplus. That's all it takes. That's what I mean about devalue the dollar. You do that first, and then now you can start cutting. Try to do it before. What happened in 2008 will look like a tea party. It'll look like a little quaint little, summer thunderstorm.
Are you optimistic that we could see the scenario of like devaluing the dollar?
Yes.
Okay. So that could...
The Americans always do the right thing after they've exhausted all the alternatives. That's something that Churchill apocryphally said. The Americans always do the right thing after they've exhausted all the alternatives.
Mm-hmm.
We've tried everything else. We've tried it all. We've invaded other people. We've done trade deals. We've done we're out of runway. Now, that ties back to my initial point of I have high conviction they will weaken the dollar next year. Do I have high conviction that, Elon Musk is a very persuasive man by all appearances? So am I convinced that he won't convince Trump to say, hey, this is a good idea. Let's DOGE first? No, I have no conviction, no visibility in that. I hope he doesn't. It will be a catastrophe for a month, 2 months, 3 months in markets. I don't know. But we ultimately know Trump is not going to stand aside and go, oh, look, the stock market's down 30%. Oh, let's keep doging, Elon. This sounds like a good idea. That's
they would
not
probably
who
pull
Trump
back.
is.
Yeah.
They would. Yeah. Elon will be out on his ear. Trump will be saying, okay, Elon made a mistake. Here's what we're going to do. Powell, fix this. Cut rates to 0 or I'll fire you. Or put up a shadow Fed. I'm going to put up a shadow Fed board, like Besant floated a while back. They will do something to do that. The only way out at this point is a significantly weaker dollar. But I have no conviction that they won't try to cut first because, look, politically, maybe they need to scare some people. There's a lot of people out there, judging by the reaction I get when I say this, I've got people threatening me on Twitter for saying this, literally. I suspect, that is an indication of how emotional people are around this. There's a lot of powerful people who want to try to cut first. It will fail. But maybe those powerful people need to be scared to death. And nothing scares powerful people like watching their 401k drop fast.
Okay, so dollar weakening is kind of the scenario you see. And then just to reiterate, from a portfolio allocation, you're a guy, you like gold and you like Bitcoin. Sometimes I have people on the show, they like gold and they don't like Bitcoin, or like Bitcoin and they don't like gold. So I do want to hear a bit more on that. And then I take it, do you want equity exposure as well? Walk us through where you want to be and what do you not want to be in? Obviously long-term bonds, but yeah.
Long-term bonds should be avoided, especially long-term Western sovereign bonds. Full stop. I have had and continue to have a decent chunk of exposure in U.S. Treasury T-bills, basically cash. Mm-hmm. I'm happy to lend money to the U.S. government for 3 months at whatever it is right now, 4.5%. Great. I am not happy to loan money to the U.S. government for 5, 7, 10, 20, 30 years at less than 4.5%. That makes less than 0 cents to me. So, and the same is true of the UK and Europe and sort of all these places. For my duration exposure is gold and Bitcoin. I look at gold, I look at Bitcoin. These are just 0% yielding bonds of finite issuance, infinite duration, and flexible face value. That is superior in every way to a 30-year bond, which is a finite duration, fixed face value, and infinite ultimate issuance. And ditto any other long-term sovereign. So definitely underweight long-term sovereign bonds. Definitely overweight gold, Bitcoin. I've got exposure to short-term treasuries, T-bills. Number one, the yields are higher than long-term treasuries. Number two, it gives me an optionality because, again, I don't know what's going to happen the next 3-4 years. I have no visibility on whether Elon and Vivek will convince Trump to try DOGE before cutting the dollar or debt versus the proper order. And if they do that, you're going to get a whoosh down in sort of everything. And then at that point, I would be deploying my what I've got in T-bills in cash into gold, Bitcoin, stocks. And so that leads to the stock side. I think equities broadly will continue to do well. I think anything related to U.S. electrical infrastructure and industrial tangentially is going to do very, very well. You can Google U.S. electrical capacity and images on Google, and it'll call up any number of charts. You can Google it on X, or you can search it on X, and you'll find these sort of the U.S. needs X gigawatts in the next 3 years of capacity, and the U.S. currently has X divided by X, 0.8x or 0.6x of that capacity. They're going to build it, right? We're not going to turn off the lights. They're going to build it. And so I think electrical infrastructure and related industrial equities, they've had good runs. I think they're still probably cheap relative to what earnings may ultimately be for these, because they are very price inelastic earnings. It's, again, utilities don't go, oops, that steel's a little too expensive for us. That transformer's a little too expensive. We're not going to build it. It is buy it, build it. We'll just pass it through to utility buyers. We'll get it from the Public Utility Commission. So those are sort of my strongest conviction areas: gold, Bitcoin, and equities broadly, but especially industrial and electrical infrastructure equities.
Mm-hmm. Yeah. Okay. Just to reiterate, though, if they DOGE first, that efficiency will blow up the system if they do that before weakening the dollar. But I do wonder, Luke, again, with the government spending being such a big portion of GDP, you mentioned 25%. I've had folks who said like north of 30. And then it seems like the jobs reports, just when you look at them, the government employment side of things, and I get we need government workers. I don't want to say, but my question is there a point where it's like too big or too much? It's a big portion of GDP. Is that normal, or what happens if you get above a certain threshold?
It all kind of ties back into that debt number, right? So once that debt gets too high, then you need to keep growing the debt to keep growing the number of government employees, and the math all starts breaking down. I think your point, though, is very well taken in that and I would add on to it that it is ultimately all sort of a symptom of the misallocation of resources around financialization and the dollar's reserve status. People say we want to be more efficient. We want to produce more. Well, let's look at our economy, right? So 25% of the GDP is government. Federal government. It's probably, you probably add another 5-10 points of sort of state local. Generally that's, they don't produce anything, right? They take a cut of every transaction, basically. They exist on the back of the productive economy. That's the nature of government. Okay. So you've got something that exists on the back of something productive is also known as a parasite, right? It's a parasitic activity, which is fine. I'm not calling government workers parasites, to be clear. It's a parasitic activity. I'm trying to make an illustration here. So 25% of GDP, at least, is a parasitic activity. Finance, by definition, is also a parasitic activity. It makes its money by taking a small cut of every transaction. Ditto insurance, real estate. So finance, insurance, real estate in this country is another what? 15, 20%? Okay, we're up to 40% of the economy that is a parasitic activity. Uh-oh. Now, healthcare administration, they're not operating on anybody. They're just taking a little cut. So what is that? Another 5 points, maybe? 3 points, 5 points, 7 points? I don't know. You're at almost half the economy that is, by definitionally, parasitic activities. What happens when you have a parasite? You get a tapeworm and it gets too large. What happens? It eats all your nutrition and you die. That's sort of what's happening. And that's why the debt is going up and up faster and faster. And that's ultimately why you have to devalue the dollar or the debt first before you DOGE. Because once the parasite gets too big in your stomach, like if you just give yourself enough medicine to kill the parasite, it kills you too. If you do it too fast. So we're too far gone to make that kind of drastic change. So you've got, the only thing you can do is basically sort of, emergency surgery, right? Which is devalue the dollar, devalue the debt, short period, brief stint of high inflation, and then you can start making adjustments. And that's kind of the immediate fix. You still have a longer term issue, problem. and again, it's easier to fix with low debt than it is with high debt, of AI, robotics, productivity, right? If AI comes out and takes 10% of administrative jobs across finance, insurance, real estate, and healthcare administration, that is functionally indistinguishable from sending 10% of manufacturing employment to China, except it's a much bigger share of employment, and we know how that worked out. Either we give everybody, all those unemployed people, UBI, subprime mortgages, whatever we want to call it, or we have a financial crisis. Again, ultimately because the debt is too big. If we had no debt and we had to kind of retrain people and run up debt to do so, we could do that, but we can't now. And so it all kind of keeps going back to point one, which is it's too late to do anything other than devalue the dollar and the debt. And I have no conviction. I think they know this, but I have no conviction in the politics of what it will take for them to convince the intransigent that think there's still other things they can do. They can't. But I don't know the politics of that.
Mm-hmm. Let me ask you one more question before I have to let you go. It's Bitcoin related and the strategic reserve. Your thoughts there?
I have long thought that the way you fix this problem ultimately is you have to, the way to cut the Gordian knot of the post-$71 system, causing this problem of forcing us to have, borrow money from China to build weapons to face down China using Chinese components, is you have to change the system. The way you change the system, the dollar system, is that you settle in a neutral reserve asset. Historically, the primary reserve asset has been Treasury bonds. And so that's been great for Washington. That's been great for Wall Street. It's not been great for America on a real basis in particular. If you settle in a neutral reserve asset like Bitcoin, like gold, and I've always thought it was gold, to be honest, but the strategic Bitcoin reserve discussion, along with various political discussions around it with the incoming Trump administration that have taken place in the public realm, make me wonder if it couldn't be Bitcoin. But the point is this: if the U.S. shifts to a neutral reserve asset, the dollar is the dirtiest dirty shirt. In other words, Bitcoin, basically, if you start seeing the U.S. will start settling deficits in Bitcoin effectively, is a potential message of a strategic Bitcoin reserve, or even of a blessing of it. I'm not convinced the strategic Bitcoin reserve will actually happen, but I don't think it needs to. I just think positive commentary from the Trump administration, but it might. Who knows? We'll see. If you shift the resettlement asset to a gold or a Bitcoin, then ultimately what you're going to do is U.S. deficits are going to be recycled into that asset instead of the U.S. issuing debt to settle that. And as the U.S. does that, because we are by far and away the biggest debtor, the biggest trade debtor, current account debtor, again, by virtue of the post-$71 system, we have to run these deficits to supply the currency for the world. If we continue supplying all these dollar deficits, but they get recycled into Bitcoin, to use the example, Bitcoin is going to the moon in dollar terms. The dollar is going to collapse against Bitcoin. In contrast, our trade partners will be receiving Bitcoin, and that is mooning in dollar terms, and being able to essentially buy up dollar assets, whatever, but trade will balance. We will be able to compete. Their currencies will be strengthening against the dollar, and in particular China, against the dollar in Bitcoin terms, or in gold terms if it's used. And that will rebalance things. And so I think it's possible. The Bitcoin reserve adds to the possibility of that. It adds to flexibility around that discussion. You've seen Scott Bessent come out and say, U.S. and China needs to rebalance. And I think we're going to have a grand deal in the next 4 years. And the U.S. needs to produce more of its own consumption. China needs to consume more of its own production. There's a lot of ways you can do that, but that is almost impossible to do without some sort of neutral reserve asset where the dollar collapses in terms of that neutral reserve asset, the yuan goes up, relative to the dollar, thanks to basically us settling more in a neutral reserve asset. And then suddenly we can compete again in a lot of things we couldn't compete before. Good for the middle class, working class, etc. So I'm watching what they say on strategic Bitcoin reserve with great interest. Again, I've always thought it would be gold would be the neutral reserve asset, but it is entirely possible that it's Bitcoin. Particularly the bigger Bitcoin gets. The knock on Bitcoin is like, well, it's not big enough. Well, at this pace, it's going to be, it's going to be half gold size and, in another couple of years. So then it starts to be big enough. So let's see. But I think the world is ultimately moving in a direction is everybody trades commodities and everybody and all currencies, or certainly the biggest currencies, and then they settle in either gold or Bitcoin.
Yeah. I got to say, Luke, we shouldn't let a year pass before we get you back on because you are incredible. And I love listening to you and learning from you. And I learned a lot in this conversation. I took a ton of notes. I want to give you the final few minutes here. Let folks know, one, where they can find you, follow you on social if you want to share that, and your work at FFTT, and any parting thoughts, anything that you'd like to leave with this audience to think about. The floor is all yours.
They can find me FFTT-LLC.com for more information about our institutional and mass market products. As you know, I'm on X at Luke Gromen, LUKEGROMEN. Final thoughts is I think we're in a really exciting and scary time. It's the old sort of crisis and opportunity all at once. Kind of whatever that meme is. But I find myself more excited than scared simply because there seems to be a greater recognition of, okay, these rebalancing dynamics need to happen. And I think they're going to happen. I think it's super important for people to understand that. And I think ultimately it's super bullish for America and for much of America. But it's likely to be bumpy for a period of time. And so I guess the last thing I say is when we talk in the context of everything we talk about, be unlevered. Do not lever. This is not something you want. The average person wants to try to trade. This is not, I think, going to be a tradable type of thing. And it's not something you want to be levered. I think you want to just play for the ultimate outcome of the rule change and be ready, scale your positions in a size that you're not freaked out by any volatility. And I think you're going to be really happy, both as an investor and as an American and as a world citizen at the end of it. I think it ends up in a much better place.
Luke Gromen, founder of FFTT, thank you so much for being so generous with your time, all of your knowledge, your wisdom, your ideas. We appreciate you. You're always welcome on this channel. And I hope you have a wonderful, happy, healthy holiday season and a fantastic new year as well. Thank you so much.
Likewise, you too, Julia. Thanks for having me back on, and go Ohio State Buckeyes.
There you go. Well, I'll say go Tar Heels. Thank you so much.